Welcome to the Riskwiser Zone. I'm your host, Lewis. Don't forget, our goal is to provide you with balanced and unbiased information to help you make informed decisions. We start with a look at the manufacturing sector, where the Institute for Supply Management's ISM Purchasing Managers Index, PMI, has come in at 48.2 for November. This marks a ninth consecutive month of contraction in U.S. manufacturing, with the latest reading indicating a slightly faster rate of contraction compared to October. Now let's break down what this means. A PMI reading below 50 indicates contraction, while a reading above 50 suggests expansion. The fact that we're seeing persistent contraction in the manufacturing sector is certainly concerning and highlights the ongoing economic uncertainty. New orders and employment indexes both dropped 2 percentage points, which is a significant decline. This tells us that companies are becoming increasingly cautious about their hiring and investment plans. In fact, 67% of companies surveyed are managing headcount reductions rather than hiring, which doesn't bode well for job growth in the sector. On the other hand, production did expand in November, which might suggest some glimmer of hope. However, it's essential to consider this within the broader context of ongoing contraction and economic uncertainty. As we look ahead to the rest of the week, there are several key data releases that could shed more light on the state of the economy. We'll be keeping a close eye on the services sector PMI, ADP employment report, and of course the core PCE price index, which is the Federal Reserve's preferred inflation measure. These data points will help us better understand whether the economy is maintaining momentum or showing signs of deceleration. And with the December policy meeting just around the corner, the Fed will be closely watching these numbers to inform their decision on interest rates. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of finance and markets, where experts are weighing in on the current trends. Recently, Vinay Rajani from HDFC Securities shared his insights on the Indian market, highlighting that despite new highs, momentum seems to be missing. He noted that the Nifty slipped below key support levels after touching a fresh all-time high near 26,330, and the pullback lacked conviction. Rajani pointed out that global sentiment has been driving the recent move, with India being one of the underperforming markets in 2025. However, he believes the Nifty is still holding on to a constructive trend, with strong support between 25,970 to 26,050. He advised traders to keep a stop loss at 25,840 for long positions. In terms of stock picks, Rajani recommended a long trade on Canara Bank around 14.3.5, with a target of 0.5t8.5d, and a short trade on Indigo Airlines around 14.730, targeting 15.730, targeting 5t700. These suggestions come as the market continues to navigate global volatility, with defending 26,000 being crucial in maintaining the bullish structure of the Nifty. Meanwhile, Santosh Singh from another firm had a different perspective, stating that the market is due for a correction, given its high valuations. He cautioned investors to be cautious and not get caught up in the hype. It's essential to consider multiple viewpoints when making investment decisions. As we continue to monitor the markets, it's clear that there are varying opinions on the direction of the Nifty. We'll keep a close eye on these developments and provide you with updates as more information becomes available. Welcome back to the Riskwiser Zone. As we wrap up today's show, let's take a closer look at the latest developments in the Indian market. We've got two interesting stories to discuss, and I'll give you my unbiased analysis of what it means for investors. First off, the Indian rupee has hit a record low against the US dollar, with the Reserve Bank of India intervening to stabilize the currency. This move has sparked concerns about the impact on the economy, particularly on imports and inflation. Now, I know some of you might be thinking, is this the perfect storm for the Indian economy? But let's not jump to conclusions just yet. The RBI's intervention is a calculated move to prevent a free fall, and we need to wait and see how it plays out. On a more positive note, the auto sector is revving up, with recent GST cuts giving sales a significant boost. Industry experts like Dipan Mehta are optimistic about the sector's growth trajectory, citing strong volume growth and improved operating profit margins. Now, I'm not one to get carried away with bullish predictions, but it's hard to deny the momentum in the auto sector. With new models and sustained consumer interest, it's likely that this trend will continue into 2026. Now, as an investor, what does this mean for you? Well, it's essential to keep a level head and not get swayed by short-term market fluctuations. The Indian economy is complex, and there are many factors at play. It's crucial to diversify your portfolio, keep an eye on the fundamentals, and make informed decisions based on your risk tolerance. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.